The market is in a tailspin after some big things happened over the last few days. Today, I wanted to share what's been happening and what smart investors like you are doing about it. I'm Ben Galloway. I'm a certified financial planner, and I help people like you manage their finances so they can get their time back. Let's get into it because this is important. Just 3 weeks ago, the S&P 500 and the Dow both hit all-time highs once again. Economic data and inflation were cooling. Blue chip stocks continued to soar on the promise of AI. This gave the green light to the Fed's long-anticipated cutting cycle. But fast forward to today, and we're in a big market sell-off. Alphabet and Tesla both reported lower than expected earnings a couple weeks ago, which kicked off this tumble. Tech stocks continued to report disappointing earnings, and the final blow came at the end of last week. Weak July jobs and unemployment reports underscored a concern that's been on everyone's lips for the last year. A recession might be close. The fuse lit last week when Japan's central bank unexpectedly and dramatically hiked interest rates. The Nikkei, Japan's version of the Dow and S&P 500, just had its second largest drop ever since Black Monday in 1987. This has huge global consequences. The sell-off is real, and investors are anxious, understandably. But a market correction shouldn't surprise anyone. Even the biggest bulls probably knew deep down that a winning streak unseen since 2007 probably couldn't last forever. And while those tech stocks that have turbocharged the market over the last year and a half are currently driving the market down, keep these 4 things in mind. Number 1, perspective. By pulling back and taking a longer-term view, the recent market drop looks relatively insignificant. The Magnificent Seven, including Nvidia and Meta, have lost over $1 trillion in market value over the last few weeks, but they're up 107 and 36% respectively year-to-date. And the S&P 500 is still up over 9.5% year-to-date. Market corrections are completely normal. Most happen every 1.5 to 2 years, and they can last around a few months. But they're important because markets that don't correct can often lead to overvalued stocks. Number 2, think of this as a great rotation. While this market drop might seem sudden, investors were already starting to shift their positions away from big tech ahead of potential interest rate cuts from the Fed. Why? Because small value companies are highly rate sensitive, meaning that they do well in a lower rate environment. As of a week ago, small caps had nearly caught up to the S&P 500 year to date. 3, cash is not king. While retreating into cash might feel like a safe bet during market turmoil, it almost always is not. Treasury yields, a benchmark for economic outlook and a safe haven for short-term cash, fell sharply over the last few days. Those nearly 5% yields investors have been enjoying have since dropped to about 3.5%, and they'll probably keep dropping. Also, research shows that once people move into cash, they have a way of staying there, often leading them to miss some of the largest market rebounds. It sounds cliche, but it's true. Time in the market is more important than trying to time the market. 4, evaluate what risk means to you. Investors view markets as less risky when they're going up and riskier when they're going down. Think of it like a roller coaster. There's a lot of safety and excitement on the way up, but it can feel pretty scary on the way down. There's risks throughout, but you'd never be advised to get out while it's moving. Together, we have to manage that risk in the market before you get on that ride, knowing that there are going to be some high highs and some low lows. Staying invested has led to the best results, and that's where we come in to help. How are you feeling about the markets and its impact on your investments? Are you hitting the panic button, or are you seeing this as an opportunity to buy in? Let me know.